Have you ever watched the news or scrolled through social media and thought, what on earth are they talking about? GDP is up, inflation is high, interest rates are changing, and you're just nodding along like it makes sense. Don't worry, you're not alone. Economics has this reputation for being complicated, but here's the truth. Most of those terms are way simpler than they sound, and understanding them can actually change the way you see money, markets, and the world around you. In this video, I'm breaking down the most important economics terms, in plain English. No complicated language, no heavy textbooks, and no boring lectures. Just clear explanations and real-life examples you can actually use. By the end of this video, you'll understand what these terms mean. You'll be able to follow economic news with confidence, make smarter financial decisions, and maybe even impress a few people at dinner parties. Let's dive in. Let's start by breaking economics down to its simplest form. At its core, economics is the study of how people, businesses, and governments make choices when resources are limited. It's all about scarcity. There's never enough time, money, or resources to do everything, so we constantly have to choose. Economics is basically the science of decision-making, whether that's deciding between building a hospital or a sports stadium, or whether you should splurge on a new car or keep saving for a down payment on a house. This is where microeconomics and macroeconomics come in. Think of microeconomics as zooming in on individual people, households, or businesses. It looks at how you decide what to buy at the grocery store, or how a company sets prices for its products. Macroeconomics zooms out and looks at the big picture, the entire economy of a country, or even the whole world. It studies things like unemployment rates, GDP, inflation, and how government policies affect everyone. If microeconomics is like examining a single leaf, macroeconomics is like looking at the entire forest. Now, let's talk about a few key terms that pop up everywhere: supply, demand, market, and opportunity cost. Supply is how much of something is available, and demand is how much people want it. When demand is high and supply is low, prices go up. Think about how gaming consoles sell out during the holidays and then appear on resale sites for triple the price. When supply is high and demand is low, prices drop, like those giant TVs that always go on sale after the Super Bowl. A market is just the place where supply and demand meet, whether that's a farmer's market, the New York Stock Exchange, or an online store. Opportunity cost is one of the most important concepts in economics because it affects every choice you make. It's the value of the next best alternative you give up when you make a decision. If you decide to buy a car with your savings, your opportunity cost might be the investments you could have made or the house down payment you could have started. In fact, economists say opportunity cost is one of the reasons time is your most valuable resource. Once you spend it, you can't get it back. First up is GDP, or Gross Domestic Product. GDP measures the total value of all goods and services a country produces in a specific period, usually a year or a quarter. Think of it as a country's economic scoreboard. When GDP is growing, the economy is generally doing well. Businesses are producing more, people are spending, and jobs are being created. When GDP shrinks, that can signal a recession, which is essentially the economy taking a nap, sometimes a very expensive nap. For context, the US GDP in 2023 was around $27 trillion, making it the largest economy in the world. Knowing GDP growth rates helps us see if the economy is speeding up or slowing down, which directly affects jobs, investments, and even interest rates. Now let's talk inflation and deflation. Inflation is when prices rise over time, meaning your money buys less. A cup of coffee that cost $1.50 20 years ago now costs over $3 in many places. Central banks actually aim for a steady inflation rate, usually around 2% per year, because a little inflation encourages spending and growth. Deflation, on the other hand, is when prices drop over time. That might sound great, but falling prices can lead to less spending, lower profits, layoffs, and economic slowdowns. Japan's decades-long deflationary period is a real-world example of how damaging that can be. The pandemic was a perfect demonstration of inflation in action. In 2022, U.S. inflation hit 9.1%, the highest rate in over 40 years. thanks to supply chain disruptions, stimulus spending, and increased demand. That meant groceries, gas, and rent shot up, and suddenly everyone became an amateur economist, complaining about price hikes in the checkout line. Next is the unemployment rate, which measures the percentage of people actively looking for work but unable to find it. In the U.S., unemployment hovers around 3.8 to 4% in 2024, which economists consider close to full employment. That doesn't mean everyone has a job. It means the number of people between jobs or seeking new opportunities is relatively small. One thing most people don't realize is that the unemployment rate doesn't count everyone. If someone has given up looking for work entirely, they're not included in the statistics, which can sometimes make the economy look healthier than it feels. If you were to visualize these indicators, a simple chart showing inflation trends over the past few years, or a GDP growth graph, would instantly reveal economic patterns, like how COVID-19 caused GDP to plummet in 2020, followed by a sharp rebound in 2021, and then inflation spiking shortly after. Understanding GDP, inflation, and unemployment rates isn't just for economists. It helps you see the bigger picture of why your rent is going up, why jobs are harder or easier to find, and why politicians never stop talking about growing the economy. These numbers tell the story of how well a country is really doing, beyond the headlines. Let's talk about money. Literally, currency is something we use every single day, but most people don't stop to think about why it actually has value. Those paper bills and coins in your wallet are just pieces of paper and metal. They have value because we all agree they do, and because governments back them. This is called fiat currency. Fiat meaning let it be done. In other words, money is worth something because a government says so, and because you trust that other people will accept it in exchange for goods and services. A $20 bill isn't magical, it's a social contract. If tomorrow we all decided seashells were worth more, guess what? Your wallet would suddenly be a beach trip away from being useless. Now let's look at interest rates, which are like the economy's steering wheel. An interest rate is the price of borrowing money, and it has a massive impact on everything from your mortgage payment to how much you earn on your savings. When rates are low, borrowing is cheap. That's why people buy homes, cars, and even start businesses more freely. But when rates are high, borrowing gets expensive, and people start tightening their belts. Take mortgages as an example. In early 2021, U.S. mortgage rates were around 3%. Fast forward to late 2023, and they climbed to about 7%, nearly doubling. That's the difference between paying roughly $1,200 a month for a $300,000 home and paying closer to $2,000. Suddenly, Dream House becomes maybe next year. Higher interest rates also make saving more attractive because your bank starts paying you better returns to park your cash. This brings us to monetary policy, which is essentially the playbook used by central banks like the Federal Reserve in the US or the European Central Bank in Europe. Their job is to keep the economy stable by controlling the money supply and interest rates. Think of them as the economy's thermostat. If inflation is running wild, like in 2022 when US inflation hit 9.1%, the highest in over 40 years, the Fed steps in and raises interest rates to cool things down. When borrowing gets expensive, people and businesses spend less, demand drops, and prices eventually stabilize. On the flip side, if the economy is sluggish, central banks lower rates to encourage spending and investment. You saw this in action during COVID-19. In March 2020, the Fed slashed interest rates to near zero to keep the economy from collapsing. Cheap borrowing encouraged businesses and consumers to spend, and that helped fuel the recovery. Fast forward to 2022 and 2023, inflation shot up, so the Fed started aggressively raising rates. It's a delicate balancing act, and sometimes it feels like central bankers are just playing economic whack-a-mole. But their goal is to keep inflation around 2% while keeping unemployment low. So, currency is trust, interest rates are the price tag on borrowing money, and monetary policy is how central banks keep everything in check. The next time you hear the Fed is raising rates, you'll know it's not just financial jargon. It's a lever that affects your rent, your savings, your job prospects, and even the cost of your morning coffee. Economies don't exist in bubbles. Countries are constantly trading with each other. When one country sells goods abroad, that's called exports. When it buys goods from other countries, those are imports. It's really just one big international marketplace. For example, the United States exports airplanes, soybeans, and tech services, while importing oil, electronics, and way too many smartphones. In 2023, U.S. imports totaled around $3.8 trillion, while exports were about $3 trillion, making it one of the world's biggest trading nations. This brings us to trade deficits and surpluses. A trade deficit happens when a country imports more than it exports, meaning more money flows out to pay for foreign goods than flows in. The U.S., for example, has run a trade deficit for decades, over $900 billion in 2022. A surplus is the opposite, when a country exports more than it imports. Countries like Germany and China often run surpluses because they produce and sell more abroad than they buy. Neither situation is inherently good or bad. A deficit can mean consumers have access to more affordable products, while a surplus can boost jobs and industries at home. But if a deficit gets too large, it can create debt and dependency, which is why politicians love to argue about it on TV. Now let's talk exchange rates, which are basically the price of one currency compared to another. If one US dollar equals 3.67 dirhams in Dubai, that's the exchange rate. Exchange rates matter because they affect how much things cost when you buy abroad. If your currency is strong, foreign goods and travel feel cheap. If your currency is weak, suddenly that vacation costs a whole lot more. Here's a real example. Imagine you're planning a trip to Europe. In early 2022, one US dollar got you about 0.88 euros. But later that year, the dollar strengthened to nearly 1-for-1 with the euro. That meant American travelers could buy European goods and services at a discount. Paris lattes suddenly felt cheaper. On the flip side, Europeans traveling to the US found everything more expensive because their currency bought fewer dollars. So imports and exports show what countries trade. Deficits and surpluses show the balance of that trade, and exchange rates determine how affordable international business and your next vacation really is. It's a reminder that economics isn't just about charts and numbers. It's also about why your shopping cart on Amazon might cost less if the dollar is strong, and why you might think twice about that extra gelato in Rome when your currency is weak. Every economy has ups and downs. It's like a roller coaster, only with fewer screams and more spreadsheets. This is called the economic cycle, and it moves between expansion and recession. Expansion is when businesses are growing, jobs are plentiful, and people are spending. Recession is when things slow down, companies cut back, unemployment rises, and spending drops. In the US, a recession is often defined as 2 consecutive quarters of negative GDP growth. A famous example is the 2008 financial crisis, when the global economy shrank and millions lost jobs. On the flip side, the years after 2009 saw one of the longest expansions in history, lasting over a decade until the COVID-19 pandemic brought it crashing down in 2020. Now, let's tackle the stock market. At its core, the stock market is simply a place where people buy and sell ownership stakes in companies, called shares. When you buy a share of Apple or Tesla, you literally own a small piece of the company. Stock prices move up and down based on supply and demand, investor expectations, and sometimes pure emotion. For instance, in March 2020, the S&P 500 dropped over 30% in just a few weeks due to pandemic panic. But then it bounced back and even hit record highs in 2021. The stock market doesn't always reflect the current economy. It's more like the economy's mood ring, reacting to what investors think will happen in the future. And then there are bonds and securities, which are basically IOUs. When governments or businesses need to raise money, they issue bonds. You lend them money, and in return, they promise to pay you back with interest. U.S. Treasury bonds, for example, are considered one of the safest investments in the world because the government has never defaulted. If stocks are about ownership, bonds are about lending. Other securities work similarly. They're financial instruments like mutual funds or ETFs that bundle investments together. Here's a simple way to remember it. Stocks are for people who want to be owners, bonds are for people who want to be lenders, and recessions are for people suddenly Googling how to make bread from scratch because they're cutting costs. Together, these business and market terms explain how economies grow, slow down, and fund themselves. And once you understand them, you'll see why headlines about markets moving, bonds rising, or recession fears aren't just noise. They're signals of what's happening in the bigger picture. When people talk about economics, they often throw around words like capitalism, socialism, or mixed economy, as if each country neatly fits into one box. In reality, no system is ever 100% pure, but let's break them down so they make sense. Capitalism is probably the one you hear about most. It's an economic system where private individuals and businesses own resources and operate for profit. Prices, production, and services are determined by supply and demand in the market. The United States is often called the poster child for capitalism, with private companies driving innovation, competition, and yes, sometimes greed. A classic example is Silicon Valley, where startups compete fiercely to be the next Apple or Google. The benefit is efficiency and innovation. The downside is inequality, since wealth tends to concentrate at the top. On the other side, socialism emphasizes collective ownership and government involvement. The idea is to reduce inequality by redistributing resources and ensuring basic needs, like healthcare and education, are available to everyone. Countries like Sweden and Denmark are often cited as examples, though technically they're not fully socialist. They're social democracies, meaning they combine market competition with strong social safety nets funded by high taxes. It's why you'll see college in Denmark cost almost nothing, while students in the US are still paying off loans into their 40s. And then there's the mixed economy, which is what most countries actually have. It's a blend of capitalism and socialism. Businesses operate in free markets, but governments step in to regulate, provide welfare programs, and manage critical sectors like defense, healthcare, or transportation. Think of it like capitalism with training wheels. The UK, Canada, and even the US are mixed economies, because while markets dominate, the government still funds things like public schools, social security, and infrastructure. Here's the key point. No system is pure. Even the most capitalist countries have regulations and welfare programs, and even the most socialist-leaning nations have private businesses. It's less about labels and more about balance. Each country picks and chooses elements depending on its values and history. So, whether you're in a place where billionaires are building rockets to space, or where healthcare is practically free, you're living in some version of a mixed system. And honestly, that's why debates about capitalism versus socialism are often oversimplified. It's not either or. It's about how much of each flavor a country mixes in. Turn on the news and you'll hear politicians throwing around words like fiscal policy, deficit, debt, and inflation targets. Let's decode those so you actually understand what they're talking about. Fiscal policy is basically the government's playbook for how it collects money through taxes and how it spends that money. When the economy slows down, governments often use fiscal stimulus, spending more on infrastructure, healthcare, or sending out stimulus checks, like during COVID-19. On the flip side, they can raise taxes or cut spending when they want to cool things down, though that's usually less popular. Nobody votes for the "we'll raise your taxes and cut benefits" campaign slogan. Now, deficit and debt often get mixed up, but they're not the same thing. A deficit happens when the government spends more money than it brings in through taxes in a single year. Debt is the total amount the government owes after years of deficits piling up. Think of it like this: if you spend $500 more than you earned this month, that's your deficit. If you keep doing that for years and borrow from friends or credit cards to cover it, that mountain of IOUs is your debt. As of 2024, U.S. national debt is over $34 trillion, which is like giving every American, including newborns, a bill for more than $100,000. Comforting, right? And then there's inflation targets. Central banks like the Federal Reserve or the European Central Bank usually aim for about 2% inflation per year. That number might sound random, but it's not. Too low, and the economy risks falling into deflation, where people stop spending because they think prices will keep dropping. Bad news for growth. Too high, and you get what we saw in 2022, when U.S. inflation peaked at 9.1%, and suddenly your grocery cart felt more like a luxury shopping spree. A steady 2% is seen as the sweet spot, enough to keep the economy moving, but not so high that it destroys purchasing power. So next time you hear a headline about fiscal policy changes, record deficits, or the Fed adjusting inflation targets, you'll know exactly what's going on. Translation: governments are juggling money, the debt is already massive, and central banks are basically trying to keep your morning coffee from hitting $10 a cup. All right, let's switch gears and do a rapid-fire round of common economic terms you hear all the time. No fluff, just clear explanations with a little flavor to keep it interesting. First up, supply chain. This is the network of people, companies, and processes that get a product from raw materials to your hands. Think of your phone. The minerals might come from Africa, parts from Asia, assembly in China, and shipping worldwide before you order it online. When COVID-19 hit, supply chains broke down, which is why suddenly you couldn't find toilet paper, car chips, or even certain foods. It's basically the behind-the-scenes conveyor belt of the economy. Next, market equilibrium. This is the point where supply equals demand. Imagine a farmer's market. If apples are priced too high, nobody buys them. If they're priced too low, the farmer runs out too fast. Market equilibrium is that sweet spot where the price matches what buyers are willing to pay and sellers are willing to sell. It's like the Goldilocks zone of economics, neither too hot nor too cold. Tariffs are up next. A tariff is simply a tax on imports. Governments use them to protect local industries by making foreign goods more expensive. For example, the U.S. has slapped tariffs on steel and Chinese electronics in recent years. The upside? Domestic companies get a boost. The downside? Consumers usually pay more, because those higher costs trickle down into prices. Now, subsidies. These are the opposite of tariffs in a way. Financial support from the government to help an industry lower costs or stay competitive. Farmers, for instance, often receive subsidies to stabilize food prices and ensure a steady supply. In 2022, U.S. farm subsidies were estimated at over $14 billion. The joke here is that subsidies are like government coupons, except instead of saving you money at the grocery store, they keep entire industries afloat. And finally, minimum wage. This is the lowest amount employers are legally allowed to pay workers. The U.S. federal minimum wage has been stuck at $7.25 an hour since 2009, though many states and countries set higher standards. The debate here is classic economics. Higher wages help workers, but businesses argue it can increase costs and reduce hiring. Either way, minimum wage laws are meant to stop exploitation and ensure workers earn at least enough to cover basic living costs, though depending on where you live, it might barely cover rent and a coffee. So there you go. Supply chains move stuff. Equilibrium balances stuff. Tariffs tax stuff. Subsidies fund stuff. And minimum wage makes sure you're at least paid some stuff. Quick-fire terms explained. And there you have it. The economic terms that actually matter, explained in a way that doesn't feel like a textbook. From supply and demand to GDP, interest rates, and even tariffs, you now have the vocabulary to understand headlines, follow economic trends, and make smarter decisions with your own money. Remember, economics isn't just about charts and politicians arguing on TV. It's about choices, trade-offs, and the systems that shape our everyday lives. Whether you're buying groceries, planning a vacation, or just trying to understand why prices keep changing, these terms give you the tools to see the bigger picture. If this video helped you, make sure to hit that like button, subscribe to Finance Simply Explained, and share it with someone who wants to finally make sense of economics without the boring lectures. The more you understand how money and markets work, the better prepared you are to take control of your financial future. Thanks for watching, and I'll see you in the next one.